try to help us break down this economic mess that we saw today, Doc David Treece is in with us today. All right, the stock market loses 600 points. $600 would have been nice.
Yeah.
Now, I'm guessing the advice is don't run to the bank, take it out, and put it under my mattress, right?
We would hope not,
okay.
Certainly.
So let's start with the credit rating. We were talking a little bit about that earlier. Now, because what we saw is not necessarily a reflection of the stock market, right? This is just a one-time event with the credit rating?
Exactly. As we were saying, this is not a circumstance that's developed within the economy. This is not a problem. The credit rating downgrade in and of itself is just an event.
Okay.
It's more a reflection of the underlying problems within the U.S. economy, within the debt ceiling debate that we saw unfolding over the last several weeks. Really, the way this impacted the market today, it was noise. It scared people, a lot of people, a lot, and rightfully so for a lot of people. They needed a wake-up call. But like I said, this is not shaping economics in this country. We started moving clients out of the market several weeks ago because we saw changing economic circumstances, a slowing housing market, an uptick in unemployment, all of these other factors that ultimately led to this downgrade.
So, okay, so does that mean that every person should start leaving the stock market and doing something else? What's the best course of action for people now?
Well, really the best course right now is to reevaluate. And there are some people that came into this well prepared. It didn't catch them off guard. There are a lot of people that were frankly caught off guard. They were living in this dreamland with way too much optimism. And quite frankly, the stock market was overpriced for where the economy was. Way too few people realized that, and now they do. Okay. Some people will have to adjust their portfolios and move to cash. Others may be willing to move in and buy equities now that stocks have really taken a hit.
Mm-hmm. Does the advice depend on how old you are? If you're 5 years from retirement, you're not going to start scooping up all these stocks, right?
This is a highly contested issue within my industry. It really depends on who you ask. There are some people who believe that the balance between stocks and bonds really depends on age, that the older you get, the more money you should have in bonds. Quite frankly, I wouldn't sell bonds to anyone right now, doesn't matter how old they are, because interest rates are the lowest they've been in 40 years. Interest rates and bond prices are the only thing in finance that we can reduce to an actual formula. It's an actual fact, it's not a theory.
Okay.
And that is as interest rates rise, bond prices fall, and vice versa.
Right.
That is the only thing in finance that works out to a formula. And with interest rates as low as they've been in 40 years, really set to go nowhere but up over the next decade or two, I can't in good conscience put a client in bonds knowing that those bonds will be hurt over the next 10 or 20 years.
But I always hear diversify. Keep a little bit in everything, right?
Well,
so then am I not doing it right with the bonds then?
Warren Buffett said it best, that diversification is a hedge against ignorance.
But I'm ignorant.
You use diversification when you don't know what's going to happen.
But I would say that's 80% of the people out there, right?
Not all. A better approach is to try to figure out what's going to happen, where the best places are to have your money, and to put your money there, and then move away when that time has passed.
But that's got to be, I mean, I know you're in the financial advisory
work intensive.
So that's, and I guess it is. So when it comes to the recession, I hear talk about a double dip. Mm-hmm. Do you think we're seeing a second wave of recession?
Quite frankly, no. As late as this is coming, I would almost have to say this is a new development in and of itself. We are seeing a little bit of deleveraging. Banks that had gotten a little bit over exuberant with lending and are having to scale back. But quite frankly, a lot of this the blame can be leveled at quantitative easing that the government engaged in, and I think we had a talk back segment about some months ago.
Yeah.
And now that the market, or the government has stepped out of the market, a lot of prices are falling because that support isn't there. But people should not be overly worried. This is not Armageddon. It's not the end of the world. Things will come back. What we really need to see are pro-business and pro-growth policies that will come along eventually, sooner or later.
All right, so we're not all going to...
No money in the mattress.
Okay, all right. Thank you very much for your time. We appreciate it. That's your Talk Back.